Yeah.
Isn't isn't a correlation merely an accepted narrative at the time? I mean, a correlation to be in fact be a correlation should have some, I'm going to use the word scientific or mathematical or empirical link as opposed to a description I'm trying to convince you of.
Yeah. Yeah. Do you have a background in science?
No, I don't.
Okay, but you have common sense in science. Yeah, one of the that's I fully agree with that for everyone here. Uh, Correlations, the dollar versus gold, for example, are logical narratives that have become conventional wisdom that have been passed down over the years because they have been reinforced. There's been a self-fulfilling prophecy, a virtual self-reinforcing cycle, and it goes like this. Well, gold's not money. And because gold's not money, it's a thing. And because it isn't really used for anything, it's a pet rock. And over the years, this people realize, well, if gold's really only a pet rock, then it's really just a proxy for the dollar. And little by little, to be fair, risk arbitrageurs back in the day said, well, people buy gold because it's a hedge for this or a hedge for that or geopolitical risk. You know what, though? But the government has changed the market structure. So it's not going to function that way anymore because it's tier three, because you can't take delivery of it, because it's been, marginalized. And so someone says, a trader says, you know what? All those bond guys buying gold, they're idiots. They should just sell dollars. So they start to trade this correlation, which initially is a risk arbitrage. And then over time, it becomes conventional wisdom. A more recent example of that uh, would be the VIX. Before 2009, smart traders knew that volatility was an indicator of the market. And then after 2009, when it became something you saw on CNBC screen, the narrative was born. Oh, the fear indicator. And volatility is what I know the best from those days. And I'm like, oh no, they're ruining it. So it becomes the self-fulfilling prophecy. So to come back to what Terry said, correlations merely become the accepted conventional wisdom, which becomes the narrative, which for a time will be even more self-reinforcing as years go on, until a big player comes on the court, a Godzilla comes on the basketball court and says, "No, I don't want to do that anymore." It's the and so a new narrative gets born years later. But we're in the non-narrative area. Well, I mean, when we were coming out of it now. But yes, so all correlations that are in finance are not scientific. They're merely an observation of when this does this, that does that. And becomes, when a critical mass of understanding of it comes and the explanation is accepted, well, gold's a pet rock, gold's denominated in dollars. If the dollar goes down, gold goes up. I will only buy gold when the dollar goes down because gold is nothing, right? It's been completely demonetized. And it's the figurine that your grandmother had in her cabinet. But it's not one of a kind. It's just gold. So shit. It goes up in price when the dollar is weaker. It goes down in price when the dollar is stronger. There's no utility, et cetera, et cetera. So yes, all correlations are made up. Now, Terry, the correlations that used to matter since 1971 and growing in importance have been Keynesian or neo-Keynesian, and they've been financial correlations, dollar gold, right? Because the dollar became the center of everything. And over the years, it went from a changeover from physical correlations, real correlations, to financial correlations. And as industry changed, correlations changed, and where it used to be the correlation of gold. And by the way, this is we've all observed this if we trade or look at gold and silver. Before financialization, the amount of silver price was more locked in or determined by the amount of gold price because they were both real assets. They both had monetary qualities and they both existed in nature. They got out of whack, but whether it be 7-1, which is the mind ratio now, or 15-1, which is the existing ratio in nature, or whether it's above ground what's available, it would vacillate in those ranges. Of course, it went crazy the other way when China bought so much silver in the 1800s that it went to like 2 to 1. Um, and that was like the end of the silver standard for the UK. But my point is, when the world was physical, I mean, it's almost like a story. I mean, it's almost like a beyond story. It's almost like a parable. When the world was physical, when the world was industrial, when the world made things, we had industry, and our money was tied to those things, and those things were tied to each other as they occurred in nature. And then we made things financial. We made things derivative. We don't care about the gold itself. We only care about what the gold does. What does the gold do? Nothing. Oh, okay. Then we only care about the financial. Silver. We don't care about the physicality of it. We only care about what it does. Does it do anything? Yes, it's used in film. Okay, so, the industrial applications matter. And then film goes away and it should revert to nature, right? No, no, because we don't use either one of them in nature. So now silver is completely tied to gold financially. And before you know it, real relationships become financial relationships. The reason I'm going into this so much is because I believe, and this is completely out there in left field, but if you're a physical person, you understand this. I believe that as gold becomes remonetized, it becomes definancialized. And so people are looking around right now in the back of their mind going, how much gold is there that I can get for collateral, whether it be in the earth or above ground? And so as gold becomes more scarce, the next person says, well, I mean, think about a panic. What do you do? Well, I can't get that. What's the next best thing? It's silver. Well, how much does that occur in nature? And you begin to see substitution looking for a new correlation. And the correlation isn't dollars. The correlation is how much gold is there? Well, how much silver occurs with gold? And so these correlations start to come back and snap back into place. And I pride myself on understanding or seeing when correlations change. The problem is I see a lot of correlations that don't change and it costs me money, but I believe this one happens. To paraphrase John Paulson, who did not talk about silver, he said there's going to be a lot less investable gold above ground in the future. It's going to be spoken for. And I'm thinking about it. I'm like, well, if you tie that concept, which he said in 2021, when he bought gold at 1750, like I earmarked it on my chart. And then you go forward and you say, well, China's taking all the collateral off the market, financialization is shrinking. And then you say, all right, well, I can't get gold. Now, pretend you're a person, or maybe you are, a person who doesn't have much money, right? Well, you can't afford an ounce of gold anymore. You can't afford the necklace that you bought for your kids because now it's an ounce of gold at $3,000, $4,000 plus workmanship. Now it's a $5,000 necklace, whereas it used to be a $1,000 necklace. And so you can't afford it. And so you start buying silver necklaces or you start buying platinum necklaces. But all the commodities, they start getting the extra demand and they all come up to their naturally occurring thing. Now, admittedly, uh, uh, I'm looking at the ideal situation. But anyway, that's what you get, Terry, when you make a comment about correlations. So I hope that was good
Yeah,
for you.
I listened there very intently, Vince, and I agree with all of that. I come from a uh, I come from a time when somebody would say to you, "How much silver do you have?"
Yeah,
Not how much money do you have, or how much
right,
coins do you have, or how many nickels, how many. I mean, I
right,
remember silver as the real McCoy, you
right.
know, and it
You
just
know,
got distracted, bent and warped into this story.
right, exactly. Yeah, that's right. And the correlations that are coming back are the one that I'm seeing come back the most is, or most importantly to me is over the years, you budget as a country, you budget for gold. How much money am I going to put into gold? $1 million, $2 million, $5 million. Well, since 2022, on top of the whole Russian thing, if you look at nations that disclose India, And China doesn't disclose. I don't call them disclosing, but India is the best country for this, or Poland actually. But India, I have that data. India started. India used to buy gold less when it went up and more when it went down because they were budgeting rupees or dollars, really, whatever you look at, right? And then after 22, they stopped buying based on price and they started buying the same amount in ounces every year. So it didn't matter the price, they kept buying. Demand has become inelastic, and that's why the Deutsche Bank analysis made me very happy. And the reason I bring that up as a correlation is what is the correlation? It's no longer dollars per ounce, it's ounces. I'm not budgeting money for silver, I'm budgeting silver. I want to buy silver. How much can I buy? Something like two silver coins was good for like a week's stay at a hotel or something like that back in the old days. So it's like, shaving a haircut 2 bits, whatever that joke was, that old song. All right, so let's move on. I don't want to. I mean, I love doing this, but I should get to this. Uh, Leon, what's different now? So much that they can now. Okay, okay. Yeah, well, I think they're in a prisoner's dilemma, Leon. Everybody knows that everybody's cheating, right? And so they're all trying to cheat without being caught. In 1971, we got caught for printing more money than we had gold. And now every nation is printing more money than they have the right to. Every nation, one way or another, until recently, pegged their currency to the dollar. And the dollar was pegged to our economy. So it used to be the dollar was pegged to gold, the world pegged to dollars. And then the dollar went off the gold standard, but the world stayed on dollars out of convenience. Now the world is going, well, we're going to print more than we need. We don't care about the US GDP and US dollars because it's not as important. How much more do we need? Well, how much gold do we need? How much gold do we need is how much more we need, which is why you'll hear the statement by people who understand and think in ounces. They're like, well, you don't need more gold. The price of gold will just go up. And that'll be your collateral. That's, which gets extrapolated to the Bitcoin thing. All right, so here we go. Why Comex gold open interest is being revised so often. That's the pseudo title of what we're talking about here. All right. Why this topic matters. Today, we're going to examine a phenomenon inside the Comex gold market that should not be happening in an electronic clearing environment. Specifically, open interest revisions are rising. Wait, let me turn the page here. I think I got to turn the page. Um, oh, here you go. Yeah. Open interest revisions are rising sharply. Revisions are largest on Monday for the previous Friday. Since the government shutdown, revisions have become extremely large, in some cases reaching tens of thousands of contracts, far above historical norms. So, why you should care? Well, it's not a technical footnote. Persistent open interest revisions indicate a failure in internal risk controls, stress at one or more clearing members, potential obfuscation of losing positions, and a threat to the liquidity pool that underpins US dollar commodity pricing. So, our agenda is I want to walk through how open interest works, why revisions happen, normally using my historical examples, what has changed recently, signs of stress and obfuscation, and systemic risk implications, then Q&A. All right, so here we go. What's the next page? All right, so how open interest is supposed to work. Open interest equals the number of outstanding contracts that exist at the end of the day. Every futures contract has two sides, a long and a short. Every matched pair open interest increases or decreases depending on what the participants already held. So open interest equals outstanding contracts. It changes when positions open or close, and electronic clearing matches instantly. Now, there are three ways open interest changes. Open interest rises, open interest falls, or open interest goes sideways. Now, you've heard me talk about that before, but I'm doing this for a broader audience at some point. Maybe someone at the Comex is listening. Um, Open interest rises. If you're not familiar, it's basically accounting, right? A new long buys and a new short sells. So I'm adding a long and someone's adding a short. Those two contracts become open interest rising by one contract. Okay. Open interest falls if we'll use selling in this case, someone who's long the contract sells and someone who's short the contract buys. Open interest drops by a contract. Old long closes and an old short closes. Sideways. You've heard me describe this in weak hands to strong hands. Uh, Old longs getting out, new longs getting in. So Paul Tudor Jones buys it. It goes up 3 months later, and he's now selling it to a momentum guy who's buying the highs. This is why you get long wicks, right? Mechanically, I'm describing mechanically what you see visually on the screen. So step one, step two, step three. I mean, it's again, that's a mislabeled picture, but it's three types of things. All right. Um, all right. So we're going to talk about what creates revisions, those things that we see when the open interest comes out. Um, what's the word, Randy, that they use? Not tentative. What's the synonym word that they use?
The prelim?
Preliminary. Yeah, I'm just
Yeah.
saying I want to use the exact words, right? So
Yeah.
they use preliminary. So preliminary is the people at the exchange take the volumes and they do preliminary. Now, and then they get the actual corrections the next day. Now, the corrections are referred to uh, out trades. So these are the minor revisions occur as the business operates because a trade was input incorrectly. A trader submitted their side to buy, but the counterparty failed to submit their side to sell. Uh, the roots of this are from the floor. So picture one of those big pits, and a bunch of people are screaming at each other, right? And during the day, I buy one from you, and we do all those hand signals, and I write it down, and it goes into my position as buy. I report it to my clearinghouse as a buy. It hits up in my statement the next day as a buy. If the guy who sold it says he sold it, they have to match. And then they go into the clearinghouse. If they don't match, we call it a break. They break. An out trade is the worst part. So an out trade is when I go to the other guy on the side of the ring and I say, hey, buy one. He doesn't know that I'm talking to him. Okay. I put in that I buy it. He says, no, we have an out, which is like a problem. Out means big problem. So these are called breaks. These happen, and it started from the floor. During the day, you'd have these people running around, clerks, of which I was one, running around saying, hey, I did this trade. You're not coming in on it. Did you know it? Like you're not acknowledging it. And you try and get these done by the end of the day because the next day you don't want any problems. You want your statement to say, I bought one, there it is. I sold one, there it is. You don't want to worry about what the other guy did or didn't do. Problems need to be fixed while the market is open. And so we were like a bunch of busy bees running around, checking with other people. Hey, Joe, your boss should be selling one to me. I don't see it hitting up on the blotter. Oh, I'll check with him. So you reconcile these. Now, with automation and electronics, that should go away. Now you're going to have problems from time to time, but it should go away. That's the whole point of automation. Historically, these revisions are small because electronic clearing matches both sides immediately. Out trades, the way they define them, are rare, very rare. Now, what is an out trade? An out trade occurs when, as I described, the buyer reports the trade, the seller fails to report, or vice versa. The exchange must, now this is where the preliminary open interest comes in. The exchange must treat the reported side as real. Therefore, if a long reports selling, but the short does not report buying, open interest must temporarily rise until the missing counterparty is resolved. Okay? So I'm long a contract and I'm selling. they have to print this as increasing open interest because they don't know who bought. So every trade is represented as an increasing open interest. You'll have some represented as closing by error, but that's a real problem. So um, the open interest must temporarily rise until the missing counterparty is resolved and you can determine whether it really is a closing or an opening. This used to happen more frequently during the floor trading days. I'm reading my notes here. But in modern electronic clearing, persistent breaks are an anomaly. Now, what has been observed in the past year? Oh, well, let me just do this slide first. Preliminary open interest is published daily. Revisions are in the next 1 to 3 days. Look, we used to have up to three. Here's the consequences of an unresolved break or out trade. On day one, your boss freaks out. He's like, why isn't this trade in my position? It should be in my position. Why doesn't my clearinghouse, which is a euphemism for prime broker, know this trade? And then the clerk gets marched in front of the boss and he says, what happened here? He goes, I don't know. Well, let's figure out my boss traded thousands of contracts. Let's figure out which contract it is. So you have to go through every individual trade, hundreds of trades, thousands of contracts. When I was trading at my peak, I was 5% of the open interest. So on a day where 20,000 contracts trade, I traded what's 1,000 contracts. But we frequently had, 50,000 contracts trade. And so I had a ton of trades. Some of them were ones and twos. Some of them were 50s and hundreds. Okay. So now the poor clerk goes up to his boss and says, what's up, boss? He goes, well, I'm missing a trade. You got to find out. So I had to, as a clerk, had to find which trade it was that wasn't matching up. And then you have to find all the people he traded with and ask them, do you know? Do you know? Do you know? Until you find the one that doesn't know. Or you find the one that says, oh yeah, I do know it. I forgot to put it in. My trader's handwriting was sloppy, whatever. I didn't do it. I didn't do it right. I didn't put it in on time. And you're like, fine, it's resolved. It'll be submitted the next day. You're given 1 to 3 days back in the old days. Now you shouldn't have this at all. It should come up immediately because when you put a trade in, when you or me or anyone else who's in the business puts a trade in, it knows what account it's coming from, right? Before you hit send. In those days, it didn't. There's really only two entities that can do trades without saying who it's for beforehand. And those are the big banks and the primary house trading firms and some hedge funds. So primary dealers get to trade and then decide who it's for. See that? I traded. I'm going to decide who it's for. Now, those of you old enough, we're not going to get into it now, but that was how, in my opinion, Hillary Clinton, back in the day, or Bill Clinton too, back in the day with Tyson Foods, was paid by Tyson Foods for their work. The good trades went into Hillary's account. The bad trades went into Tyson Foods' account. I mean, that's exactly what they did. That's like an E.F. Hutton scandal, I think. Anyway, moving on. So what has changed in the past year? Okay, so there are two charts on here. The top right-hand chart is the first one that I did, which was basically going back 250 or 300 days from Randy's data and just looking at all the changes. And there's one there that's really big, but that chart's it's a good chart for a starter, but Randy gave us a better chart, which is in the lower right-hand side. And I'll make that bigger at some point, but let me just go through what's going on. What has been observed in the past year here? Nowhere else. Like, we're bleeding edge on this. Revisions are increasing sharply. The average revision size used to be, I don't know, 200, 300 contracts, Randy, on an average day, maybe 1,000 tops.
1,000 tops, 500-ish or so. And if I can just say a little background here. For those that don't know, I started this database just for our own information purposes all the way back to July of 2021. And onset of the virus, all that stuff. So started this thing and made a couple modifications along the way. And then I started to see the prelims getting modified about 9:30 in the morning Eastern, and I started to see bigger and bigger numbers. And not, I'm not a pro, but I could see the change, so I just started noting them in my spreadsheet, and that started November of 24. And then, as you just said, the changes up until that point were 300, 500, up or down, both
Right,
directions.
right.
And then take it away. Something changed.
Yeah. So here's what changed. During the past year, and maybe before then, but we have good data for the past year, and Randy's got data going back. Revisions have trended upward, number one. Number two, they now regularly reach thousands. And recently, on that last blue bar there, they're 33,000 approximately, right, Randy?
Yep, that's
So this is
33,000.
not, yeah, so this is not a normal statistical variation. It's a sign of stress, I would contend. Now, there are other patterns. We're going to go into one of those right now. Before, here, let me just, if I can draw on this. I don't think I can blow it up currently, but let me, I'll use this. All right. So the blue lines going down, the blue, what is this, a bar graph or histogram? The blue lines going down are reflections of open interest shrinking from preliminary to final because someone did a trade, the other side didn't come in on it, and we had to figure out what was going on. And you had to wait a day, sometimes three, but it's supposed to be a day now. Now, there are several patterns in here, and one pattern that's easy to see is the precipitously regularly upward sloping numbers, looks like starting in the beginning of October. Right. And by the way, this also, just going to throw it out there, coincides with open interest staying the same or decreasing while the market is going sideways or higher. And that would lead me to believe, if I can just digress, not digress, but if I can just extrapolate for a second, that would lead me to believe that the open interest is getting overstated and then decreasing the next day because someone is closing a position as they're going into it. Now, that's the first obvious pattern. The second pattern, which is not as obvious, but the first one I noticed was when Randy started saying, "Hey, Vince, this is really happening a lot." I'm like, "Oh yeah, I'll take a look at it." And then it was happening on Friday. So it happens multiple times, but it would happen. That's a Friday, 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 Friday. Like you could see the space in between is equal. Now it happens on other days, but Friday is a day that it happens most frequently. Like this is like Wednesday, Thursday, Friday, Wednesday, Thursday, Friday. By the way, speaking speculatively, I don't know if Scott's here. Scott, are you here? All right, so he may not be. One of the things that risk managers do, again, giving you another color aside, one of the things risk managers do when they have a trader who's losing money is they'll say, I'm not going to tell you what to do day to day, but by the end of the week, I need you to reduce by this amount. By the end of the week, I need you to reduce by that amount. By the end of the month, you give them budgets on what to do. And so the first day of the week, the trader just lays back and sees what they can get done without stressing or losing money. By Wednesday, they start to stress. By Thursday, they stress more. And by Friday, if the market's running, they're freaking out because if they don't close this amount of contracts, their boss is going to get mad and they may get fired. All right. So now that's a speculative statement, but it would be consistent if this is Wednesday, Thursday, Friday. Notice how they get bigger. They get, it's small. Like the ones are like I bet you the Fridays are the biggest ones here. I can't tell, but that's the idea. So um, the timing of these observations is suspicious because Friday is the delay you would this Friday is the day you would delay reporting most if you wanted to hide a losing position. I know this from experience. In my career on the floor, when I started to study volumes and open interest to see how they would parallel or complement my volatility knowledge, I noticed that I was always wrong on Friday. And I went to an old man and I said, why do they keep changing the open interest on Friday? And he explained it to me. He said, because on Friday, sometimes people leave early and they don't submit their trades in time. And it wasn't us. We're running around on the floor trying to get this shit right. It's the banks that have desks in London that leave early, 2 martini lunch, 3 martini lunch, and they leave. That can happen where your employee doesn't report properly. But it can also happen if you want to hide from the public what you did. And amongst professionals, I know what you did if I'm trading with you. So, for example, if I buy and Goldman Sachs sells, and by the end of every day, I know who I'm buying from. By the end of every day, I can tell by the clearinghouse, by the type of account, 1C, 1A. Well, if the open interest drops by 10,000 contracts and I bought 10,000 contracts from you, you know that I'm closing. And I know that you're closing. We know that we're closing. If the market's rallying, I'm losing money if I'm buying in a rallying market and you're making money. When you see the matchups of contracts at the end of the day and what it does to the open interest before the CFTC, and you know who you're trading with, especially if you're trading OTC, because you're literally like almost you're these things clear electronically, but they trade OTC on instant message. Clearport was an example of that. I traded a lot of stuff on Clearport, and we would have to know by the end of the day, hey, did so and so come in on those contracts, and what did the open interest do? If I have a lot of contracts to buy, whether it be because I'm losing money or because I have a big order, it's in my best interest to not divulge what I'm doing for two reasons. One, if I'm losing money and they're my own contracts, I don't want people to know that I'm losing money. Oh, did you hear Vince bought 20,000 contracts today and we're 50 higher? Wow, that guy got his ass handed to him. Click. And that's it. Now it's open season on me. People will call me up or try and preference me to see if I'll trade, to see if I'm in trouble. And if there's blood in the water, people are going to take you out. The other reason, equally legitimate, is, well, I just got a $100,000 buy order, okay, from my customer, the, I don't know, MBS in Saudi Arabia. And so what I'll do is I will try and delay what I'm doing by divulging late the information until I'm done. I don't want people to know that I'm adding open interest, because if I add the open interest, they'll know I have a fresh buyer. Hey, did you hear? Vince bought 10,000 contracts yesterday. He doesn't normally buy that many. And the open interest went up. Oh, he's got a customer. Maybe it's that guy in China that he's friends with. Okay? So you will delay your reporting. You'll say, fuck it, I don't want to tell them until I'm done. And so you'll kick it down the road. And that's a tactical reality when you're dealing with big orders. More often than not, it's a sign of stress. You are distorting the open interest to either protect the fact that you're losing money, or you're distorting the open interest day to day because you're protecting a client, which is unfortunately to the detriment of the whole market structure. Okay, so again, Friday is the day you would delay reporting if you wanted to hide a losing position most. Sunday night trading is influenced by what people believe happened Friday. You'll notice I frequently have opinions when we talk on Sunday because I know exactly what happened for the 5 prior days from the CFTC report, and we've seen those 3 days, Wednesday, Thursday, Friday. And I just go, Sunday night, we're going to open higher. Sunday night, we're going to open low. And it's not intuition, or I mean, I guess it's intuition. It's technical analysis. It's technical analysis with serious understanding of the flows, because I think like these guys, because I was taught by one of these guys. All right, so a counterparty can exploit information asymmetry about your Friday trades during the thin Sunday session. You also may have noticed, for those of you when we did these, I stopped having good predictions on Sundays, because the Fridays were just, remember how the Fridays were throwing me off? Open interest went up 33,000 contracts and the market only rallied $2. I don't know. And that was me being confused, by this behavior. I lost my edge, my ability to reverse engineer. Okay, so there's that. Oh, here we go. Friday to Monday matters. Largest revisions occur Mondays. Friday is ideal for hiding P&Ls, and Sunday night thin markets respond to Friday flows. Imagine if you're the biggest hedge fund in Shanghai and you bought 5,000 contracts on Friday, and you know that you bought them from JP Morgan. And you know that you're buying from, even if you don't know it's JP Morgan, you know that you're buying from someone who's selling, and the open interest goes up and the market goes up. Well, you know that the next day you can probably run them in, right? Or if you're a macro discretionary fund, most commonly this will happen, and you're selling into a rally, and you're like, who did I sell? You always say, who did I sell to? Did I sell to another fund getting long, or did I sell to a fund that was short, or someone else that was short? And so when I sell my 5,000 contracts, I'm Paul Tudor Jones or Jeff Gundlach or some big fund, and I see the open interest drop by 5,000 contracts on Friday, I know this is a short covering rally. I know that you're weak. I know that I can make it open higher or not sell in the open and make you chase it higher. I know it's like you're sitting at a poker table. And once you see that a guy's pile is dwindling, you know he can't raise. He's got to cover. He's got to get out. And so you start bluffing pots that way. It's a big, big deal. Tactics or strategy at this level. So there you go. That's that slide. Shutdown period anomaly. Okay, so now we move to the government shutdown period. During the government shutdown, as you saw from Randy's chart, weekly CFTC positioning stopped, but the exaggeration of problems got bigger. At the exact same time, open interest revisions exploded, revision frequency accelerated, and revision volume expanded dramatically. Correlation does not prove intent. I want to be clear about that. But the pattern is classic for a system under pressure when regulators are temporarily blind. Who can actually cause this? Well, first, before I say who can actually cause this, let me go a little bit more into the mechanics of it, not at the floor level, but at the exchange level. A clearing member, the prime broker, the guy who lends you money to finance your trades, cannot or will not properly submit trades. A clearing member does not trade, does not submit trades. A house account may be hiding the true size or direction of its positions. So, a bank like Goldman Sachs, like JP Morgan, I'm not saying it's them, they are a clearing member and they have customers who trade in there. And so the customers don't submit the trades to the clearing member. So the clearing member cannot submit the trades, doesn't know about them, being lied to by his client, or his client just negligent. And so the clearing member, Goldman Sachs or JP Morgan, will police them the next day and say, hey, I'm being told that you did this trade. Did you do it or not? And so you become a problem customer. The clearinghouse fires you because they don't want to recognize they don't want to jeopardize their whole business. Now, clearing members also have house accounts, traders that work for the bank on the trading side, market makers, prop traders, hedge funds that have tremendous client access, house access. Well, a house account may be hiding the true size or direction of its positions. And so the house account fails to support to report to the clearing member, meaning his the bank itself. And maybe they don't fail to report accidentally. Maybe it's intentionally. So another way, compliance controls are being bypassed, and that happens. You basically lie. You can change the data to make something happen. It happens all the time once you figure out the glitch. Risk officers at the clearing member are either uninformed or overwhelmed. So that's it. Other entities. Well, there are really no other entities that can do this anymore. It used to be me on the floor. I could do it. I could say, well, we'll worry about it
Vince,
tomorrow.
can I
Yeah,
ask
again,
a very naive question here, if
sure,
I
Ted.
may? I listened to what you're saying with clarity, and I don't know if this is naive or just way out in left field altogether, but none of this could be going on without the complicit involvement of all parties. And that means across major exchanges too, does it not? Or is that, I mean, if I
No,
wasn't
no, no.
benefiting from this as China, I'd have your head, you know?
Exactly, exactly. Well, right. It's not a failure of one. Like there are redundancies and other sections. There's if this fail safe works, there's other fail safes all the way
Yeah,
up to the exchange. So yes, the answer is it's extremely unlikely that this would happen on any given day, let alone on multiple days, unless
right.
somebody at the highest level understood it and was
Yeah,
tolerating.
exactly. Okay. Yeah. Good. Thank you.
Why firm would delay reporting? And I'm actually going to, I'll get to that. To hide losses during the unwind, to prevent counterparties from sensing weakness, to buy time to source collateral, to mask position direction. Mechanical example, I did this. Okay, so good. I can go through this. Now we get to what Terry alluded to. Why this cannot be accidental in 2025. Matching is automatic, reporting is electronic, compliance is real time, audit trails are instant. Now, when I say the word compliance, I'm referring to internal compliance at the bank level or the clearing member level. I also am referring to exchange wide compliance. All right, I'm going to. All right, I'm going. My notes I think have. Oh, good. I did cover these notes. Perfect. Perfect. All right. So let me just read this and then satisfy my dog if you can hear them. Um, all right. Matching is automatic, allocations are electronic, traders are audit tracked in real time, and compliance is instantaneous. There is no legitimate excuse for tens of thousands of misreported contracts. This is not sloppy clerical work. It's intent and or distress. And the distress is being tolerated because someone has given assurances that it'll go away. What this pattern suggests: stress at clearing members, intentional obfuscation, limited exchange enforcement, Terry, or worsening frequency and size. I'm not judging here. I'm assuming that an exchange member is going to read this. Like I'm actually giving them an out here. Um, Systemic risk implications. Hold on. Let me get the slide right. All right. So I'm going to mute myself and take care of this persistent puppy, and I'll be right back here. All right, guys? I'm muting myself. You guys can talk amongst.
Hey, Terry. Hey, Terry.
Yes.
If you can hear me, this is Iggy. I
Yes,
just wanted
Iggy.
to clarify on the on more of the scientific level regarding correlation
Yes.
and causation. I studied a lot of etiology for my double master's and PhD and postdoc classes, but to kind of make it, I don't want to say somewhat simple, but just to add that um, things in the economic, political, biologic, ecologic, medical, et cetera, systems that we try to study scientifically,
Yeah.
these are all intricately more complex than we have the ability to um, really test for and test our hypotheses. And we're also limited by the fact
Almost
that
down to the almost down to the quantum mechanics level, eh? The
no, no,
particles there.
leave that aside. Even on the Newtonian level, right? Forget the quantum. Like
Okay.
that just complicates it even more. But just on a Newtonian level, right? There's so many variables, right? And
Okay.
then the way we do science is that we try to isolate a variable, which is almost completely antithetical to how the real world works. The real
Right.
world, like economics and individual economic players, right? There's thousands or hundreds of thousands of motivations and cultures and languages and philosophies and understanding just on the basic of finance or interest or monetary or whatever it is. So my point is these
Right. Yep.
systems are hugely complex and they're completely confounded by human behavior, right? And then we get into like something like ecology or physics even, right? And I don't want to step on any toes because I'm not a physicist, but the point being is that a lot of times we notice correlation, and a lot of times we impute causation, and everyone knows that correlation doesn't is not causation, et cetera. But part of the reason why is because a lot of times there's a confounding factor, is what we call it in the scientific.
All right, so LBMA liquidity has fractured, right? Poor policing, chronic transparency failures, and tolerance for member misreporting gradually shifted liquidity to Shanghai on the physical side. And when a liquidity hub is compromised, it doesn't collapse completely, it erodes, and then there's a sudden failure. And London actually kind of had that failure. They're just lying about it. Comex is now showing London-like symptoms. Not showing them, we're seeing them. The implications of this are commodity pricing is an important pillar that supports US dollar reserve status. So if COMEX gold liquidity fractures, the West loses control of gold pricing. If the West loses control of gold pricing, the US loses a key monetary lever. The dollar loses an anchor that enforces global demand, and Asia becomes the primary source for price discovery. So I'll give you an example on something that I just wrote up, but we're not going to talk about it now. When you wire money from Europe, let's say you're a European and you're using your bank to wire money from Europe to India, well, you press a button and your euros get converted not to rupees, get converted to dollars. An FX trader converts euros to dollars. And then he converts dollars to rupees. And then rupees come out the other end. So you're paying someone in rupees, the equivalent euros go in, gets converted to dollars, then the dollars get converted to rupees, and then it comes out the other end. Now, what does this have to do with this? Well, the pillars of keeping the dollar the global reserve currency are exactly these type of things. You can't get someone to make a market in euros to rupees, but you can get anyone in the world to make a market to dollars. And because the dollar is the most liquid, has been the most liquid, it remains the most liquid. So it's a self-fulfilling prophecy. Now, what keeps that dollar trade in the middle? We call it a market maker butterfly. So you sell, buy, and then you sell, buy. So the dollar's nowhere. One currency drops, another currency rises. But the dollar is the hub of everything. When you do this, you make it necessary to own dollars. Everything is priced to dollars. So imagine an ocean with one anchor, and that anchor is the dollar. And every nation is attached to it by a rope on a boat. And those boats have different lengths of rope, relationship to the dollar. You get the analogy. Well, what keeps that anchor anchored is the fact that they're all tied to it. And what keeps them all tied to is the fact that it's anchored. But there are other things, and this is what I'm getting into here. When you're looking to see what a dollar is worth, you look at everything in the world. The dollar is based on the dollar's economy. Well, how's the dollar's economy? Well, the dollar's economy in gold terms is this. In oil terms, is that everything is priced in dollars. And so if the price of gold goes up, well, that's a comment on the dollar. So psychologically, I'm thinking the dollar is weaker. Anyway, so I'm basically presenting what I'm saying right here to the world. Like we're getting fucked. The dollar is losing its power because we're losing pricing power, and the COMEX is just another problem. I mean, I'm not Cassandraing it yet. I'm just saying this is where it is. If gold liquidity fractures on the COMEX, Asia becomes a primary price discovery center. So it's not academic. It's already happening. All right, final conclusions. Open interest revisions are a stress signal. the scale of current revisions is unprecedented. Only major banks or clearing members have the ability to cause this, and exchanges know it's going on and are looking the other way. The pattern matches intentional obfuscation and losing positions. The trend worsened during the government shutdown when regulators were not publishing data, and this behavior threatens Comex integrity and U.S. commodity pricing power. The real conclusion: this is a crisis that hasn't been acknowledged yet. If Comex continues down this path, the U.S. will suffer the same liquidity fracture London did, and price discovery will relocate to Asia. Yada, yada, yada. Okay, but look, the government shutdown is over. Let's see if it stops. If it stops, then we know they were doing it. If it doesn't stop, then we know it's even bigger than that, and it's something that they can't stop. So anyway, no matter how you look at it, it's bad. So Q&A. That's basically it. So look at that, in an hour. What do you guys want to talk about? You can talk about anything. Doesn't have to be a Q&A on this.
Hey, Vince, can you look at that question I typed out there?
Okay, so that's right. We got to look at the IM questions. Who was that? Terry?
Richard.
All right, Richard. Does the increasing amount and frequency of downward OI revisions, that one,
Yes.
possibly indicate big banks know prices will be moving higher after a drop dead date? The date is getting closer and they are getting further behind the 8 ball to get out of short positions. Yes. But let me give you the hierarchy of how that goes down. The trader on the desk probably isn't thinking that. His boss is. So is it possible that the trader knows that there's going to be a drop dead date's a good way to put it. A drop dead date? I'd say the chances are infinitesimally small. Does his boss, the guy who runs the desk, or the risk manager know? Greater chance, but still likely low, that there's a drop dead date. Or put it this way, there is a drop dead date. Wait, by the way, drop dead date, are you referring to a big picture problem or a problem for the trader on the desk?
No, kind of a big picture problem that, okay, we know China's going to take over pricing at this date and
Right.
prices are
Okay. Yeah.
going to
That's the
skyrocket.
big picture one. Yeah. Yeah. I want to make sure that it's not that the trader drops dead because he didn't close the open interest. Right. Okay. So you're on the big picture as well. Right. So when you go up the chain, there's a trader who's been given a quantity to cover. And when he asks why, his boss says, you're losing too much money. Or he says, you're losing a little bit of money, but there's some stuff going on that I'm not sure of, I'm not privy to, but we want to be positioned for it. Maybe he's outright lied to. We have a new client coming on board and we want to clean up our books. We have an audit coming. You're given reasons that are not genuine. You're given false pretenses. Now, his boss is, and the reason I'm doing this is because this actually is where RICO comes in. Okay? The trader, you can't, like for example, when JP Morgan was accused of manipulation, and again, this presentation I just gave you is the kind of stuff that I did before, not this clean. I would just talk about it and say, look for that, look for this, and you'll find it. But when JP Morgan and other banks were being accused, the key was they wanted to make sure that there was no thread of information going from the trader to an executive. Because once you did that, you were easier to press RICO. Okay? So, as Randy and others would joke, I will joke, is there's a lot of buffers. And the buffers go from the trader who doesn't know why he's got to kill someone, in this case himself, to the boss who knows he has to kill someone, but has an idea but doesn't know. And then there's the executive. So when you get into the executive suite, whether it be executive VP or higher, managing director, formally when you're at these banks, you're talking about if the executive knows it's not just the trader, it's the whole C-suite, the whole CEO, So now you're talking about a company that's culturally corrupt. And that was the case when they were making the case for RICO or for systemic problems, that JP Morgan's executive was doing this And the trader learned it from the executive. So the executive was telling the trader to do it because the executive himself did it when he was a trader. So you're showing systemic corruption, and they have to get Rico out of there. So to answer your question, the trader doesn't know shit, Richard. The next level up knows something is wrong, but doesn't want to really know what's going on. And all the way up top, someone up there goes, yeah, there's something going on. And they may not know that it's happening tomorrow on a drop dead date, but they do have dates. Like, for example, when Basel III was passed, uh, when Basel III was passed and gold was taken to tier one, there was a drop. There was a date in Europe, but that date was known before it was announced. When J.P. Morgan and Citibank had to disclose their gold derivatives book, they had that off their books. I mean, it was on their books, but it wasn't in the gold section. They had it in the FX section. Like, did you know for years, for 20 or 30 years, several of the bullion banks had all their gold derivatives in their FX bank, in their FX account? So they viewed them as gold as a hedge for Aussie dollars because they were doing carry trades. Sell gold, buy Aussie dollars. Put those two trades together, put them in the FX book, which is really not illegitimate to do. But if you're dealing with a physical commodity, this FX crap doesn't matter because gold is a store of value. It's not currency, it's store of value, it's an asset. So at this point, treating it too much financially caused a problem. So that came out in July of, I think, 22 or 23. But I noticed that it came out, to your point, at the high levels. In succession, three or four things happened that JP Morgan was involved in. It could be coincidence. One of them was they settled their case for $900 million for the manipulation. Within months, they disclosed what their gold open interest was off their books, and they brought it on their books so that we could see it. Basel III was just passed, and JP Morgan was awarded, I think, sole custody of silver, or one of two. In silver or silver, it was silver or gold. I forget which one it was. But that's what happened, right? So somebody up there, Richard, knows. Hope that answers your question.
It
Next.
does. Can I ask a follow on that? So if we continue looking at these revisions, I kind of think that we would expect to see them get more frequent and larger until finally one day it just stops, and then
Yeah.
gold prices would likely start. And that may be an indication for us to go long, because once the banks are out of their shorts, they should be
Yeah.
ready to
Yeah,
for the
I want
prices
to I
to
want to
rise.
stop you right there with that, only because that last part there is where people get in trouble. Here's what I mean. We all see a pattern. There is an obfuscation of buying, whether it's open interest closing, it is, or open interest raising. We have to know. Now we know it's open interest closing. If it's open interest closing, it's a short covering. Now, without knowing anything else, you should not assume that when that person is done, the market will go up. You should assume that the market will go up while that person is doing it. So while the person is doing it, the market will go up. When they're finished, the market could go down. So here's what I mean. Let's give two simple examples of why this could be happening. An entity is in trouble because they're in trouble, and it happens all the time. But this happens to be a very big entity. An entity is in trouble, and they're closing their position. And the other banks see it, and they're front running them. They're like, okay, they're going to cover. Let's make them cover higher. Let's punish them. Let's run them in. Let's front run them. And the market goes higher than it should. And when they're done covering, the market collapses. Okay? That's when it's an entity that's not systemically wide. If it's only one entity, Richard, okay, the other banks kind of like, oh, look, the school of fish or the herd of deer. That one's injured. That one's going to be a sacrificial lamb or a sacrificial deer to the lions that are coming up or the jackals. Fine, cut them loose. Let's move on. That's more common, and I've seen many of those over the years. Now, to go with the conspiratorial side, this is such a big thing that it's either not one bank, meaning it's multiple banks, or it's one bank that's so important it may as well be the whole exchange. So the question, Richard, is, well, first of all, the fact is you buy while they're covering. Do you buy after they're done covering? Well, I don't know. What would really be nice is to literally see the bank. Let's say it's a bank doesn't exist anymore. Let's say it's Washington Mutual. Washington Mutual is covering. You're like, oh, they're covering. They're not done. I'm going to keep buying. I'm going to stay long until I know that they're at the end. Now, when they're at the end, I don't want to be long anymore. Seriously. If I know that they're ending today, I do not want to be long anymore, tactically. If on the next day, someone else starts buying and the open interest starts going up, I want to be long. So it's hazardous to say that the buying is because they know the market's going to change or China's going to take over. It's more reasonable to think that, generally speaking, that someone's buying because they're losing a lot of money and the rest of the banks are going to let them twist in the wind. However, this is where it goes in between what you're saying and what I'm saying is normal. It's so big that I have to think that when you have a big bank or a big entity covering shorts like this and hiding it, it's tip of the iceberg. Other banks have problems, and there are going to be other unintended consequences. So Washington Mutual is covering, and they've covered and they've exaggerated the market, but in covering, they've driven the market so much higher that, Bear Stearns has to cover. And so you have a snowball situation. Now, are they all covering because China's going to take over? No, they're covering because they're losing money. So is China going to take over? Yeah. Will there be an announcement? I firmly believe there will never be an announcement to that effect. I mean, a lot of people, we as humans, we're just so obsessed with a moment, like a label. In finance, they only put up the tombstones after the bodies are buried. And the tombstone is the announcement. In investment banking, when you take a company public, they used to give out these little not ceramic, clear plastic things, and they would have the offering memo in them, and it was like a little bit of a trophy. And I'm like, what is that? And like, it's a tombstone. I'm like, why is it called a tombstone? Well, because it's done. The body's already buried. There's bodies buried in that, and we're putting a tombstone up. So if you want to look at it from literally from a tombstone, the tombstone goes up after the body's buried. So anyway, could ultimately, way, way above our little bit of obsession analysis, be China's taking over? Yeah, but I don't think there's going to be an announcement. I think it's just going to happen. It's going to keep happening and happening and happening. And my evidence to this effect, I'm not sure you were here back then, but over the last couple of years, there have been moments where banks cover their shorts. And those moments normally occur on a day where they throw in the towel because they see some buying. October 7th, before the Israeli Hamas thing, they were covering shorts because they were told, they got tapped on the shoulder and were told, listen, we're not sure what's going on over there, but get out. And that short covering, which was normal business, started to spur the market higher, and it got higher, and the prophecy was self-fulfilling, and the market kept going until, of course, it was capped by the BIS. But that concept that I would see happen for a couple days, for a couple hours, is happening for longer and longer periods. It's been happening for a couple months. And we saw one of those happen last year when Trump won. We saw the big open interest drop while the market rallied. That was starting in April of 24. And now we had it happen in April of 25. Timing is probably a coincidence. And now it's happening again. Yeah, LBMA silver is still in backwardation. That's correct. That's correct. And we can move on to that. Hold on. Next up, grants. And if that happens, we should see high volatility. What do you mean grants, Randy?
Hey, Vince, can we follow up on one thing just to close down?
Hold on. I want to answer Randy's question. What's that, Randy?
If Grant picks this story up and runs it,
yeah,
is he biweekly or monthly? Do you know? I don't know, but if he picks this up, I mean, Grant, you know what? We're gonna spotlight here. I'm gonna pat ourselves on the back,
right.
and I'm gonna guess what you said. People are gonna see this, if they don't see it already. Maybe we're the whistleblowers. Who knows? That's not the point here. But if this gets a little traction, I don't know. Like as you said, which way it's going to go, but the volatility I think will increase because if nobody has even like floated any idea about any of this
No. I mean,
yet.
look, and to be fair, maybe I'm just like whistling Dixie. I'm not, but maybe I am. Like
Yeah.
I've seen it, but here's what should happen. Let's pretend that everyone sees this conversation and sees this slideshow. Um, if enough people start talking about it, the exchange will hear about it, and the exchange will say, "Okay, you guys got to wrap that up. I don't care. We're going to have to do an investigation if you don't." Because it becomes a rumor that becomes a problem. Um, all right, I have $100. CNBC will float this. Yeah, I mean, yeah, I guess unless the CME is their sponsor.
Yeah, tap on the shoulder.
I don't think CNBC is going to be. I think CNBC is worried about CME's sponsorship. All right, so Brit, does this Iggy? Hold on, let me get to Brit first. Does this observation about revisions imply a Sunday Monday trade opportunity currently, or short-term positioning just broken? Yeah, Brit, this observation to me, if you want to trade it as looking at it purely as a trade, which I think is what you're thinking about, it says to me that every Sunday night is a buy, right? As long as there's no news item, every Sunday night is a buy because there's going to be short covering. Unless the market comes in, it's kind of like this. Just giving you a tactical habit. If the market comes in within $5 of unchanged, it's a buy, right? If it comes in 50 lower, it's not a buy because you're like, wait a minute. I mean, it's a buy, don't get me wrong. But for a trade, it's like, it's not a buy because, well, maybe they're done buying, right? Right? But I think
Almost.
every time you have a big problem on Friday, how about this, Britt? Here's the answer to your question. You can look it up. If you go back on the data and you look at every time we had a big open interest change on Friday, up when it really wasn't up and it got revised lower, what happened Sunday night? Right? So let's say on Friday, open interest goes up by 20,000, and then Monday morning, open interest is back down. Well, if Sunday night the market went higher, you know that the person who's buying on Friday and hiding it isn't done, right? But what this did was it screwed me up because I would use the Friday open interest change in context of the previous 6 days and say, someone's covering shorts, they're going to do this. Someone's buying, they're going to do this. Oh, someone reversed on Friday, we're done. Weekends. So that's my answer. Does that help, Rick?
You
Oh,
know
yeah?
what? Every
Sunday has been a buy.
looking
Yeah,
at this
that's
real
right.
quick. Every Monday since September, well, I think with the exception of one, has been
Right.
higher than Friday. I'm looking at my spreadsheet. So
That's good. That's good. Right. There you go, Britt. So let's put this in a seasonality context. Because everybody here, most of you people here understand seasonality. Seasonality is when we're in buy season, I'm not guaranteeing it's going to go up. I'm guaranteeing they'll be buying. And if you look at every buy season, it averages, I'm exaggerating, but not by much. Every buy season ends with gold higher. And why? Because during the buy season, there's luckily, no news items to catastrophically affect it, like COVID or something like that. So if there's no surprise black swan news item, buy season happens every day for a month. And so the market will capitulate higher. So now to use the seasonality aspect for this, you want to look at it like this. If on every Friday, by the way, this is what traders do. If on every Friday for the past 3 weeks, when the open interest spikes on a Friday, the market will be higher Sunday night. That's a system trade. That's an algo trade. That's a time series trade. Forgetting what I know about the market. If open interest spikes higher on Friday, the market is higher on Monday. Is that because people bought it on Friday? That's because people didn't buy it on Friday. No new funds got in. Someone started covering shorts. So that's how I look at it. The problem with that mindset, and I do it, that's how I trade, is you can't trade all in on Sunday night. You have to assume that it's going to happen every Friday for years. And so you trade a little bit every night, and every week you hit a single. You want to see that, like it's kind of like every day at 12 o'clock, everyone goes to lunch and silver goes down. I swear, people would do that. So at 11:59, people would sell a contract, and the market would drop. And so every day, someone would be guaranteed like $500, and so that's how it worked. Um, but that's my comment about your observation. In terms of my predictive value, remember my predictive value on Sundays dropped because I was confused about Fridays. What I should have been saying is, oh, I didn't know they're cooking their books. Randy brought it up. I'm like, oh shit, that's what they do. I can't believe they're doing that. That's really bad. And so the answer would be, I don't care about all that analysis, Vince. If open interest is up on Friday, buy it for Sunday. Now, it'll work until it doesn't work. You follow? But it works. And that's what a time series algo is. A time series algo is a correlation.
Vince, here's my question. I'm a producer. Pick one, big one, little one. Doesn't with everything that we're discussing here today, or that's being discussed, which I agree with most of it, absolutely all of it, actually.
Right?
Why am I bothering to deal with you as a producer? Why would I hedge anything, even if I needed to hedge? Why would I jump into this pool of shenanigans?
You mean a producer who hedges their metal through a bank or through an exchange?
Yeah. Like
Yeah.
why would I subject myself
I'm
to
gonna give you
this
the short
exchange?
answer for that. I'm gonna give you the short answer for that now. Again,
Okay.
you're ahead of the curve. You're evolutionary in your what's the word, teleological. You're thinking teleologically. Going forward, they aren't hedging anymore, Terry. They're not using the exchange. They're doing one-to-one deals. They're negotiating with nations. They're negotiating with physical buyers right then and there. Why did they do it is really what your question is. And the question is because they were run by morons or people that were financially beholden, because they did that because their banks took them public. Their banks gave them letters of credit. Their banks gave them, as I like to say, free toasters with their checking. And so they were captive clients. That's the advantage of a bank, captive clients. So I want to make that a short answer. I hope that helps a little bit. Iggy,
It does. It does.
what did you
Thanks.
want to say? Come back
Yeah,
to?
I wanted to follow up on some of the questions I had posted in the post, but it was tying into where Richard was going, but it
Okay.
also tied into where Scott was going the last time we met, which is that
Okay.
do
So
you get any more? Sorry, go ahead.
now do this for me. Take the question that you want answered most and copy paste it and put it back in there because I don't want to scroll all the way up because new questions are
Oh,
coming
I
in.
didn't
You
I
follow
didn't know.
me?
Well, no, I put it in the chats the last few days. They're a longer question, but it can be summed up this way, which is that do you get any more clarity between this? You and Scott had kind of differences as to what might be happening, and since we're seeing it every single day, it seems very much it's not just a couple guys going to for extra drinks on Fridays in the UK or Europe. So do you get any more sense speculatively, right? For you, any more
Yeah.
sense as to whether this is BIS or people operating on behalf of BIS, or is this just someone that's
Oh no. Well,
in trouble?
Hold on, hold on. Let me before I answer that. What are you saying that Scott and I differ on? You're talking about the
Oh,
J.P. Morgan thing?
well, yeah. You guys on the last conversation, you guys were having
No,
a.
he. So I'm interrupting because I want to keep moving. Um, Scott said something. He may not be here, but Scott said something that was straight up compelling to me. I'm always hedging, making sure I know, making sure I know, making sure I know. And when you're in this loop that I do, making sure, making sure, making sure, you're never sure. And so I would say it seems like it's one entity, it seems like it's a bank, but it could be multiple banks. And then I stepped back and I'm like, but it's getting worse. It's getting harder and harder to justify my hesitancy to accuse JP Morgan of blowing out. And then Scott basically said for everyone, Scott said, look, JP Morgan's the biggest bank in metals in the world. And I went, oh, yeah, you're right. I know that. And then I went, wait a minute. Who else is on the LBMA? And there's four banks on the LBMA that are market making banks. There's JP Morgan, there's HSBC, there's UBS, and there's
Deutsche?
Standard. Standard, which is, wait, Standard is now a portion of HSBC. So who's the fourth one? Uh, HSBC, which is, I know.
Didn't UBS
HSBC
go
is
back in?
HSBC. What?
Didn't UBS? go in?
No, I got UBS. All right, I got it now. Don't no more names. I'll forget. UBS, HSBC, which is your HSBC, JP Morgan, and the fourth one is ICBC, which is something China Bank China. But it's like, one of their biggest banks. Like, it's like they're JP Morgan out there, one of them. Industrial Chinese Bank of Commerce or something like that. And they're huge as well. And so Scott keeps saying this, and I'm like, yeah. And I went, all right, so who are the bank? Who are the members? I'm like, there's only one that's making markets in the West. The Chinese bank isn't blowing out. They're making money. HSBC doesn't have the balls to do what JP Morgan does. HSBC also has Asian flows and sees what's going on. Okay. And then UBS is really just a bank that buys. They don't have a lot of selling. JP Morgan has the production in the world. How do I know? Because I know, right? Not to mention JP Morgan. I went, oh shit, this is JP Morgan. And I went, well, JP Morgan is the bank that took delivery from Comex and sent it to China in 23. JP Morgan is the bank that got their ass handed to them by China. And as much as I want to say JP, like, I guess it's a patriotic thing because maybe I do some banking there. I'm like, well, even though I hate them, don't get me wrong, on the metal side. I'm like, well, I'm always trying to hedge myself. Well, they lost money before. A Chinese macro hedge fund took them out, Zhang Kai. They made delivery, and they are the only American market maker. JP Morgan's the problem. That's it. Okay? Iggy, it's JP Morgan. It has to be. And I'm recording this.
Yeah. And I know I was going to tell you at the end of my question that you don't have to record this, but and then your speculation is that they're doing all this just to try to front for the BIS to at least give a pause in this.
Oh, no. All right, yeah. You're describing two players. JP Morgan is a bank that has, again, this is completely speculative, but it has happened before. JP Morgan is the bank that's short and is struggling. They need to cover their shorts. They have a deadline. I don't know when it is. I don't know where it is, but they have a deadline. And JP Morgan in London has a problem. So they're getting, for example, silver. They're leasing silver. All the banks are leasing silver, but JP Morgan's probably got the JP Morgan is the market maker. So if the market maker is impeded from making markets, the market explodes and then implodes. So JP Morgan, um, uh, again, this is completely speculative, but JP Morgan is the bank with the problem, right? And so what they're doing is they're trying to buy, they're trying to close all their derivatives risk, okay? But buying keeps coming in China, and they're getting the orders to buy it. Just to give you the mechanics of it. JP Morgan, I've got to buy 5,000 contracts a day. China goes, hey, JP Morgan, buy 5,000 for us too. Fuck, and I got to buy 10,000. And the customer gets satisfied first, at least ostensibly. So JP Morgan is buying, and they're trying to get some sell side liquidity. They're trying to get people to sell to them. They're going around scouring, looking for physical metal. They're doing everything that needs to be done. I'm giving you the story, but it's really not a bad story. And JP Morgan is the most important bank in the US, might be the most profitable bank in the world. Probably is. And they're systemically important. And the Bank of International Settlements is, if you're not familiar, the BIS is I call them the customer service for central banks, or you can call them the central bank for central banks. So you got the Fed, the ECB, the Bank of England, all the central banks form the Bank of International Settlements. They don't literally form it. There is an office, but they're all kind of board members. And the board member with the most weight, even though he's not the chairman, is the Fed. So when the Fed says do something, you do it, right? So the BIS, this has happened. I'm not making this up. The BIS will cap a market. And so we had a market that was in a range for 4 months, guys, from April to August. Did the BIS cap it for 4 months? No, they capped it once. And for some reason, the market worked its way out. And during that time, there was a big short covering rally. And then the market, that was this year. In 2024, There were several moments where the market was capped, I believe, by the BIS or someone as big as a central bank. Otherwise, it would not have been capped. And the market retraced, and then open interest dropped as the market dropped, which I'm fine with. And then the open interest dropped as the market rallied. Look at 2024. Capped, the market went sideways. April 2024, the market starts to rally and open interest comes in precipitously. That's someone getting their ass handed to them. That's someone slowly covering shorts. And the market broke out. Whatever the reason, the market broke out. They stopped covering. They covered enough. Who knows? Maybe they didn't see it coming. Maybe they did. And the market rallied, right? So the market rallies from April and 24 to December. And that was macro discretionary. That was Chinese funds buying. Maybe they just couldn't be dissuaded anymore. And then the whole thing went sideways again for 4 months, starting in April of this year to August of this year. April, May, June, no, May, June, July, August. April, May, June, yeah, May, June, July, or it was the end of April. May, June, July, August. End of August, boom, September, we start to rock higher. Okay, that was the same thing. How much did JP Morgan cover? Well, they probably covered a lot, but the thing is, the buying is fucking incessant. Someone is so now JP Morgan's like, I've got 10,000 to buy. They buy 9,000. Someone says, here, buy 5,000. Fuck. All right. So they're getting it done. And there's a lot of people that I believe were told to liquidation only while people got their stuff together. So to answer the bookends of your question, there's a systemically important bank that is struggling, probably an LBMA bank, probably JP Morgan. Okay? And that bank needs help keeping the market capped. This is a story, right? I don't have any proof of this. But when you combine with what Scott has said, of which I've seen the light, with what I have said, which is this is how the BIS operates, you get a systemic bank that's being bailed out or bailed in. And by the way, I want you to understand that the US government likes this. Here's what I mean. Instead of having 500 banks scatterbrained covering shorts, the US government loves the fact that they've been able to herd risk into an ETF, into one bank. They love this because the less levers they have to push to solve a problem, the better. The government says, do this. Maybe the government says to JP Morgan, listen, we don't want another scandal. You got a lot of short open interest. This thing's going up our asses. And the president might be doing something with gold. We can't disclose what, but he might be doing something with gold. You had better cover your shorts before we have to go into Fort Knox and show that we do or do not have the gold. You had better cover your shorts before the Judy Shelton bond. You had better cover your shorts. Something is going on. And so that's my answer. Iggy, does that help?
That's hugely helpful. I love when you can tie it all together. Thank you. And I know, again, I wanted speculation just based on your gut. Thanks.
Yeah. All right. So, Darren, thank you. Industrial and Commercial Bank of China. Yeah. Please keep the recording. I joined and missed most of the meeting. All right. So I haven't been recording at all, Eduardo. Sorry. All right. I'm just kidding. That wasn't very funny. Yes, I recorded almost all of it. Martin, what do you think the price happened? What do you think happens to the price of Comex gold in the event of a weekend revaluation? All right, so Martin, I'm going to ask you a question. You can type it or tell me. What does revaluation mean to you? And it's not a sarcastic question. It sounds it. What do you mean by revaluation?
If on the weekend we get, China says, or whoever says, this is the new price of gold for us, and then the world kind of adapts to it, whether that comes from the US or comes from China. But
Okay.
some sort of overnight, drop.
Right. Okay. So I mean, I'm going to push back on this now, okay? Because I hear a lot of people. That's why I wanted to get your definition of revaluation. Everyone says China's going to revalue gold. Maybe I'm wrong. Maybe I'm too American patriotic or jingoistic. But who the fuck is China? China's not going to revalue a global commodity. They're not going to say, okay, it's now worth $10,000. They got to buy it and get it up to $10,000. You follow? Like, it's a global commodity. It's not an asset they control. Now, You follow, Martin? There will be no literal revaluation moment. That's my contention. I think that's, again, people who just like to see not you, but people like to just say there is going to be a moment. There's an there's a thing that happens. You understand what I'm saying, Martin?
For sure. And
Okay,
I think okay, go ahead.
but now I want to make it real, right? So I want to disavow. There's going to be a moment where they say revaluation. I'm not mocking you. I'm just saying everybody says that. Now I'll say what could happen. See, the revaluation statement is the tombstone. It's over, right? What you might see is you might see when China owns. I'll give you scenarios that I would do if I was China. Not that I know what China would do. When I have enough gold, I'm going to tell my other BRICS partners that I have enough gold. And my other BRICS partners are going to start buying more gold. And I'm going to buy more gold. And I'm going to start running it up. And then the market's going to run up $1,000, like it just did, basically, right? And then one day I'm going to say, by the way, the amount of gold that we actually have on our balance sheet is 30,000 tons. And that's your evaluation right fucking there. The market will go to what it's worth.
When that happens, Vince, doesn't that blow the Comex and everything right out of the water?
Yeah, I mean, it makes the Comex. It would make the Comex sever deliveries. Yes,
Right.
yes,
And that
and
brings the
I'll
whole
give
thing
you.
to its knees.
I'm sorry, what?
Does that bring the whole system to its knees or no?
The whole what
I mean,
system?
well,
Dollar
there's a
system?
lot of, I'm maybe getting in over my depth here, but that's like a default without declaring a force majeure. That's just a
Yeah,
throw my hands in the air, walk away thing.
yeah. Well, I mean, there. How about this? I don't think China comes out and says, I'll give you a realistic thing. I mean, it's speculative, but it's realistic. I don't think China says we've got 30,000 tons. Let's pretend that they do, though. Okay. I think what China says is trade negotiations are breaking down. We're no longer exporting gold, and we're going to uh, take this gold that we have stored in Manchuria, and we're going to count their gold on our balance sheet as our own. Kind of confiscating regional gold. Like there's gold that's not there's this is actually very, very the more I think about it, yeah, okay. Right. So China announces we have a problem. And the problem is we're not getting along with the US and yada yada yada. So here's what we're going to do. We're going to sever ties with the US. We're not going to buy any more treasuries, not that they are anyway. And we're going to, because our hand has been forced, we're going to say uh, the gold that's at the banks, ICBC, Bank of China, even though it's their own corporate gold, well, we're going to add it to the central bank. I want to be clear about this. China said years ago, 2016, before I understood the culture, China said, when asked how much gold they have, China said, China owns gold through its people. And back then, I and everyone else who heard that in the West said, oh, they're going to confiscate their gold, those bastards. And I immediately was thinking about, anti-capitalism. I was right away, I was thinking that way. But that's not what was going on. I got educated on this years later that in China, the reason they said we own gold through our people is perceived to be that they're going to be confiscating it. No, China encourages their people to own gold out of patriotism. And China has been changing their culture for years. In 1998, when there was an Asian contagion crisis, Koreans, and you can find it online, there are pictures of Koreans giving their gold to the government out of patriotism. 1998. And China noted that and said, hey, that's really patriotic. And around this time, China's culture was changing. It was going from Maoist to back to Confucianism, back to tradition, back to all the things that respect your elders, don't kill your elders, out of the socialistic aspect of communism and more in market testing. And simultaneously, they said, well, we'll keep calling ourselves communists, but we're basically going to do capitalism. And they did the Singapore model. And the reason I'm bringing all that up is uh, because at that point, they started projecting that all these banks that have gold or whatever they have in them, they're running their own operation. We could always confiscate if we have to, but we're not going to. And after 10 years, look, you couldn't own gold if you were in China. I'm just saying that what I'm setting you up for here is the confiscation will come at the bank level, not at the individual level. That's what I'm setting you up for. Over a 10-year period, China has said to its citizens, you can own gold again. They couldn't own gold. You can have it attached to a bank account. You can take delivery of it. You can fondle it. You can do whatever you want with it. We're not going to take it from you. And at first, the people were like, yeah, he must be crazy. We understand how this works over here, right? Meanwhile, they started to trust it. Now the banks have a lot of gold. So I think one day we could wake up and China says, not getting along with the US, this is going bad, that's going bad. But we're going to start a process because they don't want to disrupt the market for their BRICS members until they've actually got the BRICS landed. And I'll give you why I say that in a second. Um, the they're going to do a process where it happens slowly. Over a 3-year period, we're going to start buying the gold off of the balance sheets of whatever. They're just going to steal the gold from their own. They're going to nationalize it. They can nationalize in a heartbeat. So I don't think to answer all that stuff and bring it to a real answer, I don't think China ever makes an announcement, even though they could. And here's why I don't think it. As long as they're working with the BRICS, as long as the Belt and Road Initiative is important to them, and this is my mathematical reason for it. The BRICS is an organization that's based on volunteerism. It's not already codified. And because when you're dealing with an institution that's voluntary as opposed to already in place, you're only as strong as your weakest player. When you're dealing with an institution that's already in place, you're as strong as your strongest player. So the G7 is as strong as the US is because we will backstop everything. All right? The BRICS, even though China is, let's say argument's sake, they're as strong as us. China could backstop everything, but it's not an established institution. China knows that the BRICS unity is only as strong as its weakest link. That's like an economics thing. All right. So when you have an institution that's not formalized, the strongest leader has to give to the juniors. I'll give you an example. Oh, you want your gold held in your country? Fine, we'll do that. Oh, you're worried about us? You're trying to create an organization. And why am I doing that as China? Because I know in the long run, I'm going to have them use yuan and buy my finished goods. Belt and Road Initiative, right? They're creating their market. And so I bring it back to this. China must do things incrementally, but never go backwards. And so I don't think they're going to say, we're taking our gold, there's going to be gold revaluation. I think all the things that I want to happen, I don't think can happen because the BRICS right now are only as strong as their weakest player. Look at the euro, for example. I'll give you an example. Here's the euro. The euro is a great example of this. When Greece was going to exit, Grexit, when they caused the euro crisis in 2011, when gold was going shit crazy and silver went shit crazy afterwards. Well, the reason that was a crisis is because the euro is a voluntary mechanism. I don't care about everyone's using the same currency. Fiscally, they all have their own bonds. And so Greece said, essentially, fuck you. We quit. You want us to pay all this money to the IMF that we don't have, and we're the weakest economy, and Germany's making all the money? We don't have it. We quit. And so they forgave their debt. Because the euro is a fragile situation, and the BRICS are fragile as well. And that's my answer why there won't be an overnight revaluation. There will be, however, someone front running an overnight revaluation, and we'll find out later. Does that help?
President Trump, obviously, this is his last kick at the cat in his term. He's obvious. I would say he's a gold guy. If to put it like that, he sees where it's coming from. He knows where he has to go. When does he run out of patience with the shenanigans? And when does he light the fuse that causes, this thing to get out of control and like JP Morgan or whatever bullion bank is in trouble is their derivatives are all put in jeopardy.
You're saying that would Trump, because of his love of gold, actually precipitate or instigate this and not care?
Well, his love of gold, but I believe his true belief that gold's got to form a basis of the new financial system and world order going forward. At what
Right,
point is he running out of time where he says, "That's it, guys. This is
right,
what we're
right.
doing"?
Um, um, well, let me just say, and I'm not far away from you, but I don't really think Trump is calling the shots anymore. Meaning
Okay.
he has marching orders, and I do believe what you're saying about gold is right. I do, however, believe that I don't know what the answer to that question is, but I'm watching other problems that are creeping up, and I'm watching how he's handling them. Like, for example, to give you an idea, um, and I put this out as a news item, but it's pretty significant. Um, Europe and India are connecting straight away now. I was talking about that analogy about the dollar
Yeah,
trades.
yeah.
Well, by them doing that, uh, right away it made sense to me why Trump has been pushing stablecoins, why Bessent has been pushing stablecoins, why they're talking about Bitcoin as the government is now telling you Bitcoin's as good as gold. Like that's crazy shit. So forgetting the fact that like people are being brainwashed by this and think it's okay because he's saying it. I'm saying to you, that's stress. That's a problem. That's urgency. So, is the urgency the fact that we know there's a deadline? No, I don't think there is. Maybe there's an idea of a deadline, a discussed deadline, but is there an urgency that we know of a specific deadline with China? No, I think we're just worried that we're really, really losing control. I mean, Europe is basically saying, in my opinion, we're not going to use dollars anymore for trade with India. And that's huge because we've never done that before. No other G7 nation has connected to an emerging market in that fashion. That's really losing control. And so, what would the response be of our government? Well, let's triple down on stablecoins. Let's quadruple down because that's what governments do. They double and triple down. I think that we'll see domestic capital controls uh, as a reaction to something China does. And that tells you there's a problem. Because once we use capital controls, maybe China is close to doing something. I mean, it's not really that helpful, but that's how I look at it. I don't look at it as there's a plan. I look at it as there's a destination and we're not sure what the path is to get to there, but we're getting there. Does that help?
Yeah, yeah, it does. It really does.
Yeah.
Yeah.
All right, let me get to these other questions, and then I want to call it a night. I'm going to go back up here. Let's see what I missed. Let's see. Uh, uh, yeah. So Martin, to answer actually, where's Martin? He move when people log in, they move around. I lose them. Uh,
Yeah, I'm here, Vince.
oh, there you go. There you go. Yeah, like when you say something, your square comes back in the middle again. So, oh, there he is. Um, so I don't think there will be a revaluation. I think the price of gold will go up before the revaluation, and that's why every time it runs up, I go, "Oh my God, the revaluation's happening tomorrow." That's what I believe, and I believe any announcement from China will be incredibly important and incredibly bullish, but not an overnight change. More like we've decided to go into this, and we're going to start doing that. I think I could be wrong, and by the way, I think that because I'm acting on that. Otherwise, I'd be out there buying more gold as I could. I still think we have time. That's what I think.
I think that what they did with copper was sort of a test for the system of like, hey, if we initiate something that does a tariff or whatever they want to call it, how is the exchange going to react? Um, I will tell you my primary reason for asking the question is because I trade out of the money call spreads,
Okay.
and I want to know, are those going to get paid off? Or am I going to get force majeured and, paid out on the Friday value instead of the Monday value?
Oh
Or
yeah,
do you
yeah,
think
yeah.
they'll,
That's
do
true.
you think, because I remember in the Great Financial Crisis, one of the things was that pretty much everything traded all the way through, you know?
Yeah, yeah.
And I just want to know if you think that will continue.
Oh yeah, yeah, yeah. Okay. I can give you personal experience from when 9/11 happened. That will help you with this. Um, in the United States, when 9/11 happened, I was on the floor then. I was there. Um, and I didn't call it propaganda then. I called it patriotism then. Everyone on the floor uh, by the end of the day, as we're walking out of the building away from the buildings, we were all like there was a communication, there was a camaraderie. It probably started top down, but everyone said, and it wasn't about being greedy or capitalistic. Everyone said, we're opening up on Monday no matter what. We're not going to let them win. And at the time, as finance people, as New York Wall Street finance people, we saw the buildings as they were trying to take down our financial infrastructure. And when you think about it, it's like there's like three area codes in there. Like there's like all these phone lines. There's millions of phones in there. Millions is probably not the right word, but you get my point. A lot of phones in there, a lot of electronics in there. And if you take the World Trade Center down, does that not also hamper capitalism? And I remember on the floor, we were like, I mean, after the buildings, we're like, we don't give a shit. We're all coming in. We will all fucking come in here and stand outside, just stand outside and form a circle, and we will make our markets function. There was an amazing amount of patriotism, and it wasn't the first time I saw it. When Iraq War, I was a clerk on the floor, running around doing those things that I was describing. When the Iraq War started, everyone on the floor the next day had fucking American flags sewn on their jackets. It was unbelievable, like capitalism, democracy, patriotism, and that stuck with me. And what I found out later on was it's an incredible loss of face if a terrorist attack shuts our markets down. And while we will say democracy is the most important thing, it's kind of like you own a website, and if that website is down for 5 seconds, that's enough for your boss to freak out, right? Because that's a loss of trade. It's a loss of reliability. It's like, a newspaper company running out of ink. So in this day and age, I recognize that more important than democracy for the United States' standing in the world is the markets remaining open. And that's why in the great financial crisis, they could definitely have shut down, but they didn't. They stayed open and they were stabilized. During 9/11, they did not. They could not. So I would say to you that even though we could shut markets down, the United States would not shut all the markets down. It would shut down a market, kind of like I'm throwing the bad actor under the bus. I'm throwing this trader under the bus as a manipulator. Well, I'm throwing nickel under the bus. I'm throwing wheat under the bus. I'm throwing maybe even gold. I don't think so. But I don't think that we will shut the markets down. I think that we will have capital controls domestically before we shut down our advertisement of markets to the world. So that's what I think, Martin. On the other hand, I have seen the CME cancel trades. So silver made like new all-time lows or something for a period. And I had friends who bought down there and they were canceled. They bought it. It hit up. It's the exchange canceled the trade. So I'm just, saying that the risk is there, but I don't think the risk of I think we'll be on what's the word? Martial law before they shut the markets down. I swear to God. That's my opinion of our priorities as a country. Hope that helps.
Great response and great perspective. Thanks.
Thanks. Leon, I don't know who's fucking calling the shots. It's the 12 Swedish, Swiss, Jewish, Italian, Vatican zealots. I don't know who it is. But I think it's like what George Carlin said. They don't call the shots with each other, but they know how things have to operate. And very rarely do they have to weigh in. All right, so Eduardo, options classes. Okay, we'll come back to that. It will be so important as the archive is almost impossible to navigate because of major Substack limitations. Yeah, I know. I got to redo the options things all over. I mean, I did them. It's like when I teach that class again, I'll redo a new one. I mean, maybe I'll just do it in little dribs and drabs. Who else did I miss? If there's a question on topic, just retype it in if you want, and I'm gonna go. Oh, Iggy said a couple things in here about Sinclair. Yeah, Iggy, you really know Sinclair's stuff. What did he say that I accidentally uh, reiterated?
Can you hear me okay?
Yeah,
Okay. Um, I want to be clear about something, having studied him and, had gone
yeah,
back
you're
to
very
maybe
familiar with his stuff. Yeah,
2005, 2006. So I wasn't the super early, really connected people. But anyway, long story short of it is that he would contradict himself at various points. So he would, and he had really,
sounds
really
like
good.
me. That sounds like me. Okay,
Yeah. Well, again, we all do because we have cognitive dissonance and we're assessing various hypotheses.
whatever. Just tell me about Jim. I want to hear about Jim.
Okay. So Jim would say it's not a process, or it's not, it's a process, not an event. But
Yeah,
then he would also discuss that it's going to be a Sunday night revaluation
yeah,
where they're just going to mark it up to 25,000, 50,000, 100,000. And then he would say that basically what China's going to do is China's going to come out and say, I remember this was 10, 15 years ago.
yeah, yeah,
He's
yeah.
going to say, hey, maybe it's more like 5, 7 years ago where he really
Right.
kept repeating it. But he would say that China was going to come out and say, hey, we've got, I'm making up the number now, but let's just say 50,000, tons of gold. And we're going to put it all in a big open, soccer field or something like that. And we're going to show it to the world. And then they're going to revalue, and then they're just going to support that price. And that's why I made some of those comments, because kind of like what you were saying is that
Oh, yeah, 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 yeah,
they're
yeah.
they're just going to bid it up to wherever they want it to go and where they can defend it,
Right.
and to a level that will bring money into their sphere, into their sphere. But again, so many people, like, again, me included, we can contradict ourselves because we don't really know how they're going to do it.
Right. I think, thank you. I appreciate it. That was Martin. That was you who asked that question before, right? Was it you?
About the Comex?
No, about the overnight. We wake up one day.
Yeah, yeah. Well, that's part of the Comex
Yeah,
question,
I remember
the
because like it was
revaluation.
a too late. Yeah, I'm losing my mind. All right, so I actually can refine what I said very briefly in sympathy with what Iggy said. I think every risk manager, of which I am one, always looks at the worst case scenario and what they would do in the worst case scenario. China's worst case scenario, or maybe it's their best case scenario, is to just do something like Iggy's describing or Jim Sinclair described. Okay? Maybe there definitely is a plan Z. If this happens, we're going to do that. And I don't think we're near that happening, but we're getting worse. And here's why I don't think we're near that happening. If they were to do that, it could be world war. It could be war within 6 months. It would completely destroy. It would, forget about gold. We'd be, we'd be invading Tibet. It would be like Taiwan, fuck you, it's ours now. Like, it's crazy. Um, but when I think when Jim Sinclair is, uh, perceived to be contradicting himself, I think what he's doing is he's thinking about the worst case scenario, and he's going, one day. I mean, this I could see myself saying this. One day we might Martin, you and I are having a beer or coffee or whatever, and you and I are sitting down, and I go, you know what? One day we might just wake up in China and say, fuck it, right? We have 30,000 tons of gold, and we're going to do our version of yield curve control. Instead of bidding bonds up to keep the yields down, we're just going to keep buying gold until it goes to $30,000 or until we get our way. And the US would shut down its gold markets. That's what would happen. You would have to have access overseas. I mean, it's crazy. Like, they would disrupt Western markets by doing that. Could they do that? Yeah. Would they do that? Probably not, unless all the other bricks are long. But we'd probably see a $2,000 run up beforehand. Um, uh, Tactically speaking, I was getting a little bit worried in that run up, and because I knew that the run up had to do with the negotiation between Trump and Xi, and I noticed that the run up stopped as the negotiation started. And I said, okay, let's see how gold comes out of the negotiation. And gold came out of the negotiation extremely volatile, but nowhere. And I said, okay, then everybody's still got open interest to cover. People are covering risk, and whatever's going on is not done. And they're going to have another conversation. And I don't know when that conversation is, but I'm going to keep patiently I'm thinking like a bank now. I'm going to patiently keep closing my risk. And when I hear there's a new discussion date, maybe it's March of 2026, then I'm just going to start buying. That's it. That's where I am. That's it. That's where Sinclair was, I think. That's where I think it
And
was.
Vince, let me follow up on something really important relating to Jim and what he said. He really emphasized, especially before COVID and during COVID, and it changed a little bit in the year and a half after COVID happened and before he died.
Right.
But he said, look, there's going to be a fake, if you will, a fake
Oh, the
reset first.
two-tiered revaluation, the two-tiered one?
Yeah, the two tiers. So there's going to be a fake revaluation or reset, and the
Right.
first reset they're going to let it run the gold price to 2,500 or 3,500, some arbitrary number, and then they're
Yeah.
going to cap it there, and then they're going to make everybody think that there's a reset, or they're going to announce a reset. He said,
Right.
but that's the fake reset. That's the
Right.
one done by the academics, and then they're going to basically let China do the revaluation, and the West is going to be seen to fight it, and then in the end they're going to take credit for doing it themselves. So this is what always made me wonder if there was a lot more cooperation behind the scenes to kind of seesaw this up and
Yeah.
ratchet this theater between East and West. And that's not really the reality of what's going on. They're planning the new system, or they've got it
Yeah.
planned.
Let me just comment on the cooperation. I'm almost, I mean, you can look at it many different ways, but the ways that I look at it is it's a divorce. And both these nations know that in a deglobalization environment, we have world wars. We had World War One was started from deglobalization, among other things. World War II was not deglobalization, but World War One was. Deglobalization brings receding prosperity, and some nation gets screwed, and a world war starts. Now we're in that situation now. Deglobalization, and I think you've got the two biggest powers working together in a divorce to make sure the kids aren't hurt. And I believe that the Jim Sinclair concept, he's probably talking about when he talked about it. He was, I mean, I'm only guessing, but it's really not crazy what he's saying. The US does a revaluation. Just think about the US the key for the US is not appeasing China. It's it's solidifying its domestic position. So if we raised, I'm making this shit up, but I understand what what was thinking about. We get the price to 4,500 or five, maybe it's $6,000 now, but we let the price go up as long as it's orderly. And then if it gets crazy and we have to pull the trigger, we pull the trigger, act like we're acquiescing, and say it goes to $6,000, right? Or maybe we acquiesce and we say it's worth, I mean, I'll make everyone here happy, right? Um, Gold goes up for the next year for another $2,000, and but it gets out of control, and the BIS can't keep a lid on it anymore, and China's no longer playing well in the sandbox, and they just keep buying, and then the U.S. says, "Hold on," to its own people. We're raising the price of gold to $10,000 here. Give us your gold, we'll give you $10,000. I mean, to make it even more dramatic, and it looks like we're capitulating. But what we're doing is we're locking our own people in. I mean, I'll be paranoid for you. Look, you guys think I'm reasonable. I'm the biggest tinfoil hat out there. I keep it in. We're going to raise the price of gold to $10,000. You give us your gold, we'll give you the money. We're done. U.S. gets all the gold back it wants to. You don't have to sell your gold, but you'd be stupid not to. Prices are still reasonable here. You sell the gold, you say, oh, I'll take the dollars, right? Now the U.S. has more gold. It faces out and says, we've solved our problem. You can have gold trade $10,000. We're certifying that gold trading $10,000. Problem solved. And then it doesn't work because now nobody has any gold, and the inflation actually starts to go up because gold is dragging things higher, because gold is nature, and nature will it'll be disaster, right? Or you'll have stagflation because gold's so high, nobody's producing. Everyone's putting their money in gold, and the Fed will have to print more money and more money. And eventually, China says $10,000 isn't high enough. We want it to be $20,000. And then your second reset happens. And that will be China just saying, fuck your reset. Because the reset that Sinclair's talking about, the let's fix it at a higher price, that's market control. It's It's capital controls through gold confiscation. Same fucking idea. And by the way, if I want to just buy into what Jim said, before you do that, you have to get Bitcoin under control because you don't want people taking their money and leaving the country. That's it. So yeah, it can happen.
And let me
Anyway.
throw this out really quickly too. Jim had always said that it was through his family connections
Right.
in banking that he knew a lot of this, but several of like he was a student of Harry Dean Schultz, and he was
Yeah.
also very close with Ira Harris. So,
Okay.
and then let me also throw out that there is a current gentleman named Peter, I think Peter Carlin is his name, who used to write a lot of Jim Sinclair's website like 15, 20 years ago. And
Uh-huh.
he started speaking recently on Jim again. So my point is he might be actually a really good person to bring on and have like have one of these Sunday conversations with.
What's his name?
I think his name's Peter Carlin. I can get
And
it.
Peter was the website master, I guess, for
He wasn't a webmaster. He was one of like the higher ups and inside students going back to like 25 years ago.
Okay.
Like he was even before me. I came in, I want to say around 2003 to
Okay.
2005, something like that.
Right.
And it is Peter Carlin is his name.
Right. All
But
right.
yeah,
I'm gonna stop it here because I gotta go. Martin, I just want to say this. All what Luke is saying correctly is that if the price of gold is higher, that serves as that serves as a hedge for deflation. Gold is a sponge, right? The money that's going into gold is in gold. And by the way, that makes China happy because they have gold. It makes us happy because we're getting an orderly rally in gold. And everyone in the US, we're a minority, people buying coins and bars. Most people in the US don't do that. They use ETFs. So if the price of gold marches to $10,000 and the financial markets are not disturbed, it's not in the headlines on the mainstream media. As long as stocks keep look the way to do look, I want to do this. If I know, if let's say I'm the guy that is agrees with Luke and I'm running the country. All right, we need gold to go higher. Let's let it find its own balance as long as it's not disrupting us. So gold goes from competing with the dollar to Scott Best said, gold goes up when people buy it. Gold goes down when people don't buy it. It goes from we hate gold because it's a sign of inflation to do you ever hear anyone really talking about gold the way it used to be talked about? You don't see anyone in the mainstream media going, gold's up, inflation must be higher. No one says that anymore. They just say gold's up. And stocks are on all-time highs. So as long as stocks keep going up, as long as the machinery functions smoothly, they'll tolerate a higher gold price. And when it gets out of hand, someone will step in and cap it. And when that someone steps in and caps it and it doesn't get capped anymore, either China's not playing well in the sandbox or you've got a genuine problem. So going back to Luke, I don't care about $10,000 gold. It's a sponge, just like Bitcoin is. Besides, most people in America have their money in ETFs now. That's it. Yeah, right. That's it. All right, so we could talk for hours on this, and you know what? I can put this on mute and stop recording if you guys want to continue the conversation. But I got to do some shit. I got to do some shit. All right, so I'm going to. First of all, thank you so much. This has been a great conversation. I learned a couple things here as well. Um, um, yeah, is that good that I'm agreeing with Jim Sinclair or that I'm coming to the same conclusion? I guess it's good. It's pretty scary though. Uh, Yeah, I can picture myself sitting there going, fuck it. We might wake up one day. Like, that's what I was thinking when it was. I was like, oh, fuck it. We're going to wake up one day. Trump and Z are going to have an argument, and gold's going to be at $10,000, and I will not have bought what I said I would buy. Like, that was me having my Sinclair moment. Oh, happy Thanksgiving to all who are American and celebrate, and anyone who's in Canada. Canadian Thanksgiving is, I think, coming up as well. And for all those people in Great Britain, so sorry. Sorry, buddy. Sucks being you right now. No, I'm just kidding. Is Nigel here? He
Yes,
was
Brits are on
yes,
vacation
I'm
today.
here. Yes, I'm
Oh,
here.
okay.
And you know, we get our turkey at Christmas anyway.
You get your what?
We get our turkey at Christmas.
I know. You know,
You're sick of it
I
by then.
thought My family, well, Italian Americans, my family was always ham at Christmas, lamb at Easter, turkey at Thanksgiving. So, but it was always a Christmas ham. But that's American, right? Okay, guys,
Good
thank
luck.
you so much. Yeah, ham is better, I guess. I don't know, but I like the stuffing. Usually you get both. Someone brings a ham, someone brings a turkey, that type
Yeah.
of shit. All right, so what I'm gonna do is I'm going to turn the recording off. Let me do that right now.